So this is the first time we've ever risked 3.5 asset classes bubbling at the same time. If and when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before. I think since I said that, we could take out the rivaling 1929 and 2000. I think we've gone way past that. There are examples of large-scale craziness, meme investing, etc., for which there is simply no parallel in 1929 even, or 2000. 2000 had pet.coms, and they were kind of glorious, but they were scores of millions or a few hundred million. We have crazy things now that are billions, and in some cases, tens of billions. And to start at the top with my own favorite, QuantumScape, because we invested 8 years ago when it was 3 years old. QuantumScape is a research lab that came public through one of these infamous SPACs quite recently. But wonderful as they are at research, they came public with 4 years still to run before they have $1 of revenue, which is quite remarkable when you think about it. And they came at 10, as always is the case.
Right.
And by December, January, they were 132. And at 132, my investment, which coincidentally was the biggest investment I had ever made, had become hundreds of millions.
Wow.
And at 10, I had made 4 times my money, which is very good indeed in
Yes.
7 years, but not enough to write home to your mother. But at 130, it was 13 times 4, or 52 times my investment, which was the largest ever. And it was bigger than the market cap of GM. It was bigger than the market cap of Panasonic, to talk batteries. And it still
Right.
had 4 years to run before it had $1 of anything. And the irony, of course, was I'd been sounding off about SPACs as an invention of the devil designed to lure innocent investors onto the rocks. And there I am, having this giant investment in a SPAC. And the second irony was I was holding forth that we would be lucky to reach June the 1st before the bubble broke.
Right.
And we were not allowed to sell until approximately June the 1st because we were locked up. And during that lockup, we watched it go down from 132 to 25. So we were the most impressive speculation, I think. There is nothing like that at scale, even adjusted for current dollars in 1929. And we are down 80%, which is a fairly fearful decline, but along with us, the next tier of speculative stocks also came down. The SPAC index is down
Right.
over 20%. I think you've nailed it. The market is a self-correcting mechanism, but it's a little wonky in the time it takes.
Right.
Sometimes it corrects pretty quickly, and sometimes it corrects incredibly slowly. And that's the problem. But if you go back to 2000, which is the previous leader in speculation, let's say, what happened there is the market peaked in March of 2000. And between March and September, the pet.coms basically went out of business. The internet stocks basically went down 80%, but the whole .com, the whole TMT bubble burst, and the industry, which had been 30% of the market, declined by 50%.
Right.
The S&P was unchanged.
Yes.
And you could have said during that 5-month, 6-month window, oh, isn't that healthy? They're selling the flakiest pet.coms and they're buying Coca-Cola. What's not to like about that? And
Right.
that's exactly what happened. And I like to think of them as the kind of pessimism termites. And they ate through the craziest first, and then the junior growth stocks, and then the intermediate growth stocks. And then finally, Cisco, which was for 8 minutes or so, the biggest company in the world by market cap. And they were
Yes.
all down collectively 50%. And so for the S&P to be flat in September, it meant that the balance of the market was up 17%. So that looked incredibly healthy, but then the termites reached the broad market and the entire 70% rolled over and fell 50% in 2 years. And the NASDAQ was down 82%. The thing about the underpinnings is they always look terrific. In 1929, the market didn't peak when they thought the underpinnings were terrible. They peaked when the market's enthusiasm for the underpinnings was approximately the highest it had ever been in history. In 2000, in March, the world uniformly, including the boss of the Federal Reserve, Alan Greenspan, they all thought the system had never been better.
Right.
At the top of the housing bubble in 07, Bernanke and the boys thought the US housing market had never declined, unquote. It merely reflected a strong US economy. The underpinnings were great. They have never gotten it right. The Federal Reserve in particular has never had a clue about asset bubbles. It doesn't even address it. They act as if they don't exist, except on the upside, they occasionally take credit for the wealth effect helping the economy along. And it does.
Right.
There is an income effect, and it does help the economy along. And Greenspan, Bernanke, and Yellen all took credit explicitly for helping the economy along. What they never did is they never took discredit for the reverse side. The market has been reverting mechanism, and eventually
Right.
it goes back to a fair price. And when it went back in 2001, 2002, it had a dreadful negative income effect. When the housing market collapsed and it took the equity market with it, it had a double-pronged negative effect on the economy. So it had a much bigger impact on the economy than had occurred in 2000. And this time, we're really playing with fire because this time, unlike 2000, we have an overpriced bond market. Jim Grant would argue the most overpriced in 4,000 years.
Right.
We have, in my opinion, and that of many other bubble students, the most overpriced US equity market in history. We have a housing market that 3 weeks ago reached the same multiple of median family income as it did in 2006 at the peak of the housing bubble. And we have commodities that have recently run amok, so that the Goldman Sachs index of non-energy, which is food and metals, which are pretty important, have just equaled the peak of 2011, which was said to be one of those super cycle commodity events. So
Right.
this is the first time we've ever risked 3.5 asset classes bubbling at the same time. If and when we reach a period of pessimism, the potential unraveling in terms of perceived wealth is much greater this time than it will have ever been before.